first quarter is seen, I think, as an aberration by most of the respondents to our CNBC survey. 45 folks responded, economists, strategists, and fund managers. They see growth stepping down from the 3% level of last year down to 2.4%, which is still above trend, and 1.9% in 2020, which is thought to be around potential. 22% chance of a recession next year. That's down for the second survey in a row. It was 26% back earlier this year. Constance Hunter, chief economist at KPMG. Wait, one more thing before that. I just want to show you here the factors in growth. The global slowdown seen taking about 30 basis points off of growth. Tariffs, another 20 basis points. But the tax cuts are seen adding about 40 basis points, and that would be on a permanent level. That's thought to be in addition to GDP. Constance Hunter, chief economist at KPMG. She's upbeat on the numbers, saying they're above potential, but the U.S. is vulnerable to shocks, whether of our own making or due to economic conditions outside our borders. Let's take a look at the main threats to expansion. A third say it's global weakness. 17% say protectionist trade. And this one has appeared. The president's temperament has appeared. 10%. It's been not an issue until recently. It was back 17% in December 2017, but it's come back recently as a concern for some in the market. But Mike England, chief economist at Axiom Economics, writes in response to the survey, the 2019 U.S. growth slowdown is proving much smaller than the market feared. The Fed will need to boost its growth estimates. Of course, Kelly, you know, the economic outlook is key to the policy outlook.
As always. Come join us on set, Steve. President Trump firing off on the Fed again, tweeting a couple minutes ago, blaming the Fed's rate hikes for holding back the economy and calling on the Fed to cut rates by 1 percentage point now, saying the U.S. economy has the potential, if so, to go up like a rocket. Also saying there should be some quantitative easing. Let's talk more about this with Stephen Stanley, who's chief economist at Amherst Pierpont Securities. Welcome to you.
Good afternoon, Kelly.
So real quickly, let's start on what the president has just said. Given that the Fed decision comes out tomorrow, do you think he's trying to, as I suggested earlier, move the goalposts further so that, hey, maybe if they only cut it a quarter basis point, it won't seem so bad?
Well, he's a master negotiator, right? So you set on an extreme position and then hope to split the difference. Maybe so.
Yeah. In quantitative easing, Steve, in a way, we're probably going to see the Fed doing more bond buying, at least if you look out over into next year, right? I mean, just to then hold the balance sheet steady. Well,
yeah, eventually the balance sheet will catch up with the needs of the economy, and they'll be buying again. But I don't know that economists would necessarily call that quantitative easing. That's just more kind of the normal tracking that the Fed does to keep up with the growth in currency, for example.
Yeah, sure. No, I know, but it's still the idea that they're in there, you know, when the economy's strong.
Well, maybe that would satisfy the president.
Yeah, true.
You know, Steve, we were talking last week and a little bit. It feels to me like the president has taken jawboning to a new level with respect to the Fed. It's not as though he's the first president to put some heat on Fed chairman, but he's certainly doing it in an aggressive way that is unusual.
No, it doesn't feel that way, Tyler. It is that way. Statistically, you can show that the president has probably made more comments about the Fed publicly, certainly than all of the presidents in the 20 years I've been covering the Federal Reserve, and probably all of the presidents in the 20 years before that. Towards what end, and is it good for the central bank? Is it good for the economy? I think we'll have to wait.
So let me get to the other question that follows that. Is he right? Is he right?
About what?
That we would be a lot better off economically if rates were down a full point and the Fed was stimulating the economy. And do we need that?
Let me tell you that I guess what I can say is that the president's recommendation is an out-of-sample recommendation. It is not one that exists among almost anybody that covers the Federal Reserve or enacts monetary policy in the United States. We could, I suppose, juice the economy and run it hotter than it's running now with the fear of two things, financial bubbles that would burst and inflation. Probably have a little leeway on inflation for maybe lower rates. But what we do know is that the Federal Reserve would very much like to get its balance sheet back to something that is normal and to have a little bit of ammunition for a recession. If we were to have a recession and follow the president's policies now, the question is, what would the Fed have in the tank to fight it?
Stephen Stanley, question on that for you. I mean, is there a case to be made that the inflation data is so low that it says, hey, forget the fact that growth is strong. It's proving that it's not raising inflation. So there's no reason for the Fed to say, oh, we're going to go ahead and raise rates in this stair-step manner. Should rates be structurally lower if inflation is as well?
Well, I think at this point in the near term, with inflation, core inflation being relatively soft, the Fed is certainly not going to be raising rates. We'll see how that plays out going forward. The Fed's in kind of a tough spot with regard to inflation because they're starting to lose faith in what their models have always told them, which is that a strong economy eventually generates inflation. And if they don't believe that anymore, then it's hard for them to know what does cause inflation and therefore how to respond to it.
And final question, Mr. Stanley, to you on this, which circles back to the nomination of Steve Moore to the Fed board. Is that a nomination that you think is appropriate, both because he is a very political guy, but also because of his views on monetary policy, which in this case call for lower rates?
Right. Well, I'll tell you this. I kind of maybe mixed feelings on this. I think I would like to see someone on the Fed who is a believer in the power of tax cuts and kind of the supply side message that he's made so familiar. I think the question is one of tone, and is he the proper messenger for that? Because if he's someone who's viewed as partisan, then the other folks on the Fed may not be willing to really listen to him and give him an honest listening.